Welcome back to Smart Stock Sam, the channel where we cut through Wall Street noise and find the real story hiding inside the numbers. If you are new here, hit that subscribe button right now, because today we are diving into one of the most dramatic, confusing, and genuinely fascinating stock situations I have seen recently. Picture this. A company beats its own revenue guidance, raises its full-year outlook to levels that would make most CEOs blush, reports record subscriber growth, maintains positive free cash flow, and the market responds by absolutely obliterating the stock, wiping out 16% of its market cap in a single after-hours session. That is exactly what just happened to HIMS and HERS Health, ticker HIMS. And right now, most investors are looking at that headline loss and sprinting for the exits. But I want to challenge you to look closer, because underneath those ugly surface numbers sits a company undergoing a structural transformation that could permanently reshape how Wall Street values this business. The question burning on every serious investor's lips right now is brutally simple. Is this crash the generational buying opportunity of the year, or is the market smarter than we think, quietly warning us to get out before things get worse? By the end of this video, you will have everything you need to answer that for yourself. The full earnings breakdown, the strategic pivot explained, the institutional footprints, the technical setup, and a precise, actionable trade map with real price targets. Stay locked in, because this one gets very interesting, very fast. Before we dig into charts and numbers, we need to understand the three pillars driving all of this drama, because without context, the headlines make absolutely no sense. Pillar 1 is the pivot. HIMS and HERS spent the last year building a significant business around compounded GLP-1 medications, the weight loss drugs that took the world by storm. High margins, massive demand, explosive revenue. Sounds perfect, right? Except that model carried an enormous Achilles heel, regulatory risk. The FDA does not love compounding pharmacies playing in the same space as brand-name blockbuster drugs, and management knew the clock was ticking. So in March of 2026, they made a bold, expensive, and arguably visionary move, signing landmark distribution deals directly with Novo Nordisk and Eli Lilly to sell branded Wegovy. One stroke of the pen transformed HIMS and HERS from a regulatory target into a competitive distribution powerhouse. And the proof of real-world scale is already showing up in the data. The company fulfilled over 125,000 branded Wegovy shipments in just the first 6 weeks of the partnership going live. That is not a pilot program. That is traction. That pivot is expensive in the short term, and that cost is exactly what the market threw a tantrum over. Pillar 2 is the reaction. When Q1 results dropped after hours on May 11th, the street saw one thing only: a massive margin collapse and a net loss that came seemingly out of nowhere. Gross margins fell 8 full percentage points. The company swung from a $49 million profit a year ago to a $92 million loss this quarter. Investors panicked, algorithms fired, and 16% of market cap evaporated before most people finished reading the press release. Pillar 3 is the setup. And this is what genuinely excites me. We have extreme short interest colliding with heavy institutional conviction at a historically significant technical floor. When those forces meet, the outcome is rarely boring. What we are watching is a high-stakes game of chicken between retail fear and smart money confidence, and one side is going to flinch first. Let us trace exactly how we arrived here, because the price action over the last 30 days tells a genuinely wild story. Just a month ago, HIMS was the undisputed darling of the telehealth sector, surging more than 45% to a high of $30.56 as investors piled in, betting heavily that the GLP-1 pivot would be truly transformational. The momentum was real, the narrative was compelling, and it looked like nothing but smooth sailing ahead. Then came what I call the Amazon factor. On May 7th, Amazon Pharmacy dropped a bombshell announcement. Same-day delivery for oral Ozempic was now available through their platform. HIMS shares immediately sold off 5% on the news. The fear was obvious. If Amazon is delivering weight loss medication to your door the same day you order it, what does that mean for a telehealth platform trying to compete on speed and convenience? But here is what caught my attention immediately. The smart money stepped in almost instantly, producing a textbook V-shaped recovery back to $29.14 by the May 11th close. That kind of rapid, decisive institutional buying in the face of retail panic is a meaningful signal. It tells you that somebody with very deep pockets and very serious research looked at the Amazon announcement and decided it was not the death knell the retail crowd feared. But the calm did not last. After hours on that same May 11th, the earnings hit, and the reaction was devastating. Despite beating top-line revenue expectations, the stock plunged nearly 16% to $24.51. So, what exactly was in those numbers that scared everyone so badly? Let us go line by line, because this is where the real story lives. On the positive side, the headline numbers are genuinely impressive. Revenue came in at $608.1 million, up 4% year over year and above the company's own guidance. Total subscribers grew 9% to a record 2.58 million people. Free cash flow remained positive at $53 million. If you looked only at those three numbers, you would think this was a great quarter, but the bottom of the table tells a completely different story. Gross margins collapsed from 73% all the way down to 65%. Net income swung from a $49 million profit in the prior year period to a $92.1 million loss. On a per-share basis, that is a loss of 40 cents when Wall Street was actually expecting the company to be profitable. This was not a minor miss. It was a total reversal of the profitability trend that had made HIMS such an exciting story. The market looked at that swing and made a fast, emotional decision. But here's the question I want you to sit with. What if most of that damage was intentional, temporary, and already embedded in a strategic plan management had laid out months ago? Would that change how you see this stock? Let us examine why those margins fell, because the explanation matters enormously for whether this is a permanent wound or a one-time storm. The gross margin collapse breaks into three distinct buckets. First, the company absorbed $33.5 million in non-recurring restructuring charges and inventory write-downs, the real cost of exiting the compounded GLP-1 business. You cannot stop making a product without writing down the inventory already sitting in a warehouse. That is a real cost, but crucially, it is a one-time cost that does not repeat next quarter. Second, average revenue per subscriber fell 6% to $80 because management deliberately shifted to shorter shipping cadences during the transition, structural and temporary. Third, the company set aside $15 million for an ongoing Federal Trade Commission investigation into their cancellation and privacy practices. $15 million is not pocket change, but it is a defined, limited liability, not an open-ended black hole. Add those three items together, and you can see that the vast majority of the pain this quarter was either non-recurring or directly tied to a strategic transition management had already telegraphed. The street reacted to the headline without reading the footnotes. That mismatch between perception and reality is exactly where opportunities are born. Now, while all this turbulence played out in the domestic U.S. market, there is a growth engine quietly firing on all cylinders that almost nobody in financial media is talking about. International revenue grew by 969% year over year to more than $78 million. 969%. That is not a typo. That explosive expansion was fueled by the acquisitions of Zava and Medici, giving HIMS and hers an instant footprint across Europe. Meanwhile, in non-GLP categories domestically, momentum is building fast. Their testosterone therapy vertical is seeing 95% of customers report measurable results within just 2 months of starting treatment. Menopause is emerging as a serious new vertical. The company is actively diversifying beyond being just the hair loss or the ED platform that most people still think it is. If the international segment is growing nearly 10 times in a single year, while domestic margins are temporarily compressed, that is a very different story than the one the 16% sell-off is pricing in. So, what does management actually think the future looks like? They have called 2026 their defining year, and they raised full-year revenue guidance to as high as $3 billion. Yes, they slightly lowered their EBITDA expectations, citing investments in artificial intelligence infrastructure and international expansion. But the long-term roadmap remains unchanged and, frankly, audacious. By 2030, management is targeting $6.5 billion in revenue and $1.3 billion in adjusted EBITDA, a compounding annual growth trajectory of roughly 20% over the next 4 years. If they execute anywhere close to those targets, anyone buying shares near current levels will look like a genius in hindsight. There are also 2 specific dates on the calendar that every HIMS investor needs circled in red. First, mid-2026, when the company expects to close its $1.15 billion acquisition of Eucalyptus, instantly giving HIMS and hers a dominant healthcare platform presence in Australia and Japan. Second, and pay very close attention because this one could be a genuine game changer, July 23rd and 24th. That is when the FDA holds a critical advisory meeting regarding peptide reclassification. Could that meeting potentially unlock a billion-dollar commercial vertical that does not even exist on their current revenue model today? That is a question I would not want to be short going into that meeting. Speaking of short sellers, let us talk about who is actually positioned in this stock right now, because the divergence playing out is genuinely unusual. On the institutional side, conviction is overwhelming. Total institutional ownership stands above 90%, and Vanguard, one of the most methodical, research-driven investors on the planet, recently increased its HIMS position by a staggering 72%. When one of the world's most conservative asset managers is aggressively adding as retail investors panic sell, that signal demands respect. But there is a legitimate red flag I will not sweep under the rug. The insider buy-to-sell ratio over the last 6 months is 0 buys against 22 separate sell transactions. Not a single insider has purchased shares on the open market. The CFO and COO have been consistent sellers. Massive institutional accumulation paired with 0 insider buying is a divergence that must factor into your risk calculus. It does not invalidate the bull thesis, but it demands honesty. Now let us look at the technical picture, because fundamentals tell you what something is worth, but technicals tell you when the market might finally agree with you. The RSI has cooled to 63.8, pulling back from overbought territory into a more reasonable accumulation zone. The post-earnings crash broke the stock below both its 50-day and 100-day moving averages, which is clearly bearish near term. But the stock landed almost precisely on its 200-day moving average at $25.09. This is the most widely watched long-term trend indicator in all of technical analysis, a line in the sand that institutional systems pay enormous attention to. And then there is the short interest situation, which is where things get genuinely combustible. Short interest stands at 30 to 34% of the float, approximately 70 million shares sold short. The days to cover ratio sits as high as 4.49. In plain English, if any positive catalyst hits this stock, short sellers cannot exit fast enough to avoid serious losses. A violent short squeeze is not just possible. It is structurally loaded and waiting for a trigger. The options market is already hinting at where traders expect this to go. On May 11th, call volume represented more than 67% of all options transactions. Massive open interest is concentrated at the $30 and $35 call strikes. The options market had priced in a move of 14.8%, and we got almost exactly that to the downside. With that implied volatility event now behind us, the stock is searching for direction based on real buyers rather than speculative pressure. That creates a much cleaner price discovery environment going forward. So let us tie everything together. HIMS and hers is deliberately sacrificing near-term profitability to build something much harder to replicate, a compliant, scaled, pharma-partnered distribution platform. The $33 million restructuring and FTC scrutiny are ugly line items, but the Novo Nordisk and Eli Lilly alliances are competitive moats built on FDA-compliant infrastructure that no competitor can spin up in a single quarter. Once those one-time transition costs clear the income statement and gross margins normalize back towards 70%, which management fully expects, the profitability profile of this company returns with force. That is the definition of a coiled spring. The actionable entry zone is between $24.50 and $25.50, aligning perfectly with 200-day moving average support and the after-hours low established after the earnings reaction. Your mandatory stop loss is $24 flat. If the stock closes convincingly below 24, the bull thesis is structurally damaged. Protect your capital without hesitation and do not negotiate with yourself about it. That discipline is what separates serious investors from the ones who hold losers forever hoping for a miracle. On the upside, Target 1 is $29.46, closing the post-earnings gap. Target 2 is $31.86, the current Wall Street consensus. Target 3, the full short squeeze scenario, is $35, the JP Morgan price target. Buying near 25 with a $24 stop and a $35 objective is roughly a 10-to-1 reward-to-risk setup. Even reaching Target 1 from the entry zone represents approximately an 18% return. The growth engine is intact, the partnerships are signed, the subscribers are at record levels, the international business is exploding. The market may have just handed the best entry point of 2026 to anyone patient enough to look past one messy quarter. Now, before we close out today, I need to be crystal clear about something important. Everything in this video is for educational and informational purposes only. Nothing here constitutes financial advice or a recommendation to buy or sell any security. Investing in individual stocks carries significant risk, including the possibility of losing your entire invested capital. Always conduct your own research. Consult a licensed financial professional before making investment decisions, and never risk money you cannot afford to lose. The stock market rewards preparation and punishes impulse. Use this analysis as a starting point, not a finish line. All right, Smart Stock Sam family, that is your complete HIMS breakdown. A 16% crash that tells a very different story when you look past the headlines. A pivot that costs money now but could build a decade-long competitive moat. A technical setup where extreme short interest, institutional conviction, and a critical moving average floor are all converging at once. Now I want to hear from you in the comments right now. If HIMS and HERS nails that July FD a peptide reclassification meeting and closes the Eucalyptus deal on schedule, does HIMS reach $35 before the end of 2026? Or does the complete absence of insider buying reveal something darker about what management privately believes? Drop your answer below. I read every single comment, and I genuinely love this debate. If today's breakdown added real value to your investing process, hit that like button right now. It takes 1 second and it helps this channel reach more serious investors who deserve analysis like this. Subscribe so you never miss the next opportunity when it surfaces. And if you want to go the extra mile in supporting Smart Stock Sam, send a super thanks directly through YouTube. Every dollar goes straight into deeper research, better data, and sharper breakdowns for all of you. Until next time, stay sharp, stay disciplined, and keep making smart decisions. See you in the next one.